Think the market's already priced in all the good news? Think again. Mossavar-Rahmani believes Wall Street's pessimism is actually setting up investors for more upside, and what she sees for the market's future, even with economic uncertainty and political drama.
Sir, for Goldman Sachs Wealth Management, good morning to you.
Good morning.
I'm
happy to go by my first name. That's okay.
We've known each other a long time, and every time you know what it is? It comes up in the teleprompter, and it's just like,
it's out of nowhere.
It's a lot. It's a lot. We're seeing some of these earnings reports. Obviously, the banks look better than ever. The question is whether you think the rest of the economy looks the same way.
Well, we actually think earnings will continue to surprise to the upside. So we've already seen plenty of that, right? So to date, you're looking at about 8% of companies have reported, and we think that consensus earnings is actually too low. Consensus earnings actually expects a slight decrease in the actual value of earnings per share. That happens so rarely. 90% of the time, earnings per share sequentially between Q2 and Q1 go up, including recession periods. So the pessimism, in our view, sets a low hurdle. So that's generally going to be good for the equity market.
And do you have any...
And with the economy weakening, especially in the second half, and people have already downgraded their growth expectations. So in certain ways, that's already priced in the market. Initially, we went into the year, people thought 2+%. Some were at 2.3, some 2.5. Now people are plus or minus around 1.5% growth. So clearly, from an economic perspective, there is.
Do you think it's already baked into the cake that we've got a problem?
Well, I wouldn't call 1.5% a problem. You want a little bit of a slowdown so you have less inflationary pressure.
Right, but where are you ultimately on the tariff story and whether that's going to start to impact things? I mean, it was very interesting to just even look at CPI and then PPI and whether you think that, by the way, that could be the margin right there.
So one of the interesting points about inflation, and we encourage clients to think a little bit about what it was like during COVID. Everybody was, is this transitory? Is it persistent? And it took quite a long time for the economic numbers to get over the noise from COVID. We think the same thing is going to happen with tariffs, right? Tariffs, we started the year at about 2.5. We're now at about 14. Right. And the reality is nobody knows exactly where we're going to end up. Somewhere between maybe 15 and 20%. That's what our expectation is. Let's take the midpoint. And so we know that will create its inflationary pressures, but we don't exactly know in the entire supply chain who will absorb how much. So the assumption is the producers can absorb about 20%.
Did you come out with a report that said 40% was going to be borne by the U.S.
consumer? Our colleagues in Global Investment Research have 20% producer, 20% U.S., 40% U.S. businesses, and 40% the consumer. But over time, that number might get to 70%. So that would create some inflation.
He was looking at other things, and I always look at, you know, what you've been saying when you come on, and you started the year bullish, and you never really wavered, even, and no one knew about the tariffs necessarily, and even in April, you're telling me you actually, I don't know if I call it doubled down, but you even got more bullish at the lows in April, and they added to positions, right?
Yes, that is correct. We encourage clients
to have... That's no small feat through this.
Well, we think in this environment, trying to separate the noise from the signal is very important. There is just so much noise out there.
Without Shep Smith.
And when you look at the actual reality of what's going on, there are some valid points, no matter what people's view are of this administration, there's some valid points.
Right. Is there an opportunity to get another April low, you think, or have we seen the end of that sort of an opportunity if somebody is waiting to get back in?
Well, in some ways, we've seen the playbook, right? So people are going to be cautious about saying, let's sell, because it rallied so quickly, right? It got to its pre-liberation day levels in a month. It got to the previous highs in just over 2.5 months. And so the idea that anyone could time it exactly, sell at the right time, buy back, and pay taxes in the interim is unlikely.
What are you thinking for 2026?
Generally positive earnings.
Still.
We have our
positive
US,
market.
And positive market, yes.
Really?
So, but our views are always driven by the earnings. What will the earnings be? And then our view is prices follow earnings. There might be volatility around it, but if you have good earnings...
This OBBB thing? Did you think
there's some good points and some not so great points.
I got a different one for you.
Yep.
Yes.
We're going to have a whole segment on it in just a moment. But if, in fact, somehow Jay Powell was pushed out of his job for whatever reason, rightly, wrongly, we could debate all that. What do you think actually would happen to both the equity market and also the bond market and the dollar?
So obviously, markets don't like uncertainty. But when you think of the two leading candidates, and you think of the entire FOMC group and the Board of Governors, will any one person make such a dramatic change one way or another? You've had so many people on the program who have said it is hard to make a call whether another cut is justified anytime soon.
Right.
Our base case is they would cut 2 to 3 times, maybe starting in September. And so would it make that big a difference in terms of who's there? In reality, in terms of the earnings of the U.S., no. In terms of market sentiment, probably a quick drop, and then things will settle down and recover. If that were to happen.
But that's so interesting because you have all of these CEOs, including, by the way, your own, calling for Fed independence, Fed independence, Fed independence. But when you start to look through like the actual implications of something like this, and I'm not encouraging this, by the way, I just wonder whether you actually would have
some lower rates.
Well, and then the question is longer term, though, does the Fed independence piece of it get sort of undermined in some kind of terrible way?
Well, the president's already come out again and said he's not going to do it. He said that multiple times. Being controversial is part of the nature of this administration. Right. And so I think people underestimate the extent to which, since Lyndon Johnson, presidents have tried to pressure the Fed chair, right? Even President Reagan.
I remember, with Volcker.
In. So it has been very typical of presidents to do that. So that part is not that unusual. Again, separate the noise from the signal.
Just doing it so publicly.
The style of it is not so great.
Right.
It's not so effective.
I don't know if we've had a president who's threatened them to say, I will fire you, though.
No, they did behind the scenes. They were even more furious.
Well, I think they've screamed at them.
I can't remember. There was some anecdote about, I can't remember what it was, but it was even worse than what we're hearing right now. Do you remember?
I think Lyndon Johnson was pretty public about it.
Yeah, he said something about
his white Cadillac having the Secretary.
I mean, nasty. It got kind of ugly. Like this is ugly now.
But the problem with
it being so
public, it
makes it impossible for them to cut.
If the Fed to actually do, even if they want to cut rates,
to
actually do it, because it looks like they're caving to it and thereby giving back the independence, which is so important.